Welcome back, everyone. Thank you for joining me as always. Today, we are looking into Watkin Jones Plc, a rather high dividend yield property management and accommodation company. This right here is Google's normal search screen. Simply by putting in Watkin Jones shares, you can get this page here. Their ticker symbol is WJG. If you want to throw that into Google, that'll also work. From this page, you can compare them to other competitors, have a look at their financials, and you get their market summary. At the moment, they're trading at about 99 pence. Now, that means they're down 58% in the last year, trading almost as high as £2.60 as of April 2022. Now, come September, you can see this massive drop into October. That's when the interest rates were hiked, and many UK stocks and the economy at large took a bit of a nosedive. Now, there has been some recovery, but it varies from stock to stock. Does that mean Watkin Jones could be a potential pickup in some portfolios? Perhaps. We're going to have a wee look through it anyway and see how it looks. Pay ratio 19.07. Yield, as I said, eye-watering 7.45%. Market cap 254 million. The best place to go after viewing this screen is, of course, their own company website. Gives you access to it here, Watkin Jones Plc. Jumping over to it, it is here you can find everything, I mean everything you want to know about Watkin Jones. From their history, their vision, their group strategy, board of directors, policies. A lot of people like to look into the history of the company. Watkin Jones, quite old, founded in, I think, 1790. Let's see, is that correct? 1791. I was close enough. Now, the history of a company, really good to look into. Some people like to see their vision, their strategy. Some people actually go into the board of directors individually to see where they worked. It's quite amazing how far you can go in the investing side of things, but it's what is important to you, what you want to find in this company if you were looking at investing. Divisions, another important section. They currently operate in the build-to-rent, student accommodation, accommodation management, and residential. Clicking into any of these sections will obviously give you a more detailed overview as to what that entails. From here, you can go to the investor side of things, get regulatory news, everything from tax strategy to corporate governance. ESG scores are available as well, and results and news. From here you can find the financial calendar, the annual general meeting, and contact us as well. Be sure to check out their website if there's anything here you particularly want to see. Let's jump over to Simply Wall Street, another really useful website that I use. It is free to use. There is a paid version. Links are all in the description of these websites. Now, Watkin Jones here is a wee overview. Engage in the development and management of properties for the residential occupation in the UK. Their wee snowflake here, which is a way of measuring the company. They score 2 out of 6 on valuation. They score 4 out of 6 on future growth. That's pretty decent. 2 out of 6 on dividend and 5 out of 6 on financial strength. 0 out of 6 when it comes to past performance. So that is something that we will have to have a wee nosy at. Excellent balance sheet with reasonable growth potential. Okay, so gives you all the information at the top here, a wee bit of a glimpse in the past year performance of the stock, and any other information you may need. Now, let's have a wee look here. Good news, it's trading at 59.6% below their estimated fair value. We'll be looking at more of that later. Earnings are forecast to grow 27.21%. Dividend yield, though, is not well covered by earnings or cash flow, right? We'll have a wee look at that. High level of non-cash earnings and profit margins are lower than last year. Okay, all things, and there's a wee notebook here if you want to add anything whilst you're doing your own research through a company. You can have a look at their competitors here. Sometimes, Simply Wall Street's Australian company, sometimes the competitors are correct. Sometimes you do have to alter it yourself. So always have we double check at these when you see them. It gives a price and history performance chart similar to Google, but this comes with the advantage of being able to click into all these wee dots here. The green are dividends, financials purple, management is like blue, strategies. You can also toggle them on and off, and clicking into them will give you a wee bit of an information on what was going on at the time. It can indicate situations as There can be drops related to dividend increases or decreases, so they're always good points to have we look into. Recent news is also provided. Sometimes there is an amazing mountain of news here, and other times not so much. Green tends to be good news, red, as you can imagine, more negative. Shareholder returns, minus 58%. That would be rough. It was in your portfolio a year or two ago. Now, they're considered actually not that volatile, although the industry as a whole in the real estate has been volatile over COVID and exiting of the pandemic. The About Us section here provides a whole lot more information. Their CEO at the moment is Richard Simpson, and their website is also provided. So, as you know, operating through those 4 segments, affordable homes as well, and they do all the management side of things too. Pay ratio of 18.7 times and a price to sales ratio of 0.6. Now, we'll have to see how that stacks up to other competitors later, as this on its own doesn't tell us an awful lot straight away, but when you compare it to others, we can tell a bit of a bigger picture. Earnings 13 million, revenue 407 million. Let's see, gross profit margin 16.61%, net profit margin 3.3%, quite low, but their debt to equity ratio only sits at 16%, so that's not too bad either. Pay ratio 141%. That's pretty extreme. We'll have to see why that is the case. I guess cash flow has certainly decreased over the past while for them. Valuation, they scored 2 out of 6, being only below fair value and significantly below fair value. The rest not stacking up too well for them. As I was saying, their peers here that you've seen earlier, deemed competitors, simply going in and editing them, you can find whether or not they are companies that you want to directly compare them to. More so, I would lean towards the industry side of things for the real estate. And the industry average pay ratio is about 9.5. Watkin Jones obviously operating near double that, so it's something to bear in mind. But always look at the companies that are around them on the industry side of things, and you can make a bit of a bigger picture out of it. Now, when it comes to their share value, or their share price versus fair value, this is done on a discounted cash flow model. We will be looking at intrinsic value later on in the episode. They are 59.6% undervalued. Fair value £2.45. Now, what that amount tells us is that it is considered that £2.45 is about right value for the stock based on this model. Now, it's a model, not concrete, but you can take a wee bit of solace in it that it was trading about £2.60, which actually would have been deemed overvalued at the moment in less than a year ago. So something to bear in mind. You can see analyst forecasts as well. Down to future growth though, 27.2%, which is a pretty excessive growth for the next few years. If they pull it off, obviously their share price will benefit greatly from it. We can see free cash flows actually went into the negative over the past year. They had positive into 2021, and obviously through COVID and other measures, things haven't went too well. They are forecasted to, fix that problem in the coming years, but that remains to be seen. So we'll have to keep an eye on them for that. Past performance, they were doing quite well up until the pandemic, and that just seems to be a pretty similar story. Revenue has actually grown, but earnings is what's taken the hit over the past while there. So let's see, their operating expenses hasn't actually increased all that much either. Down to financial health, they scored very well in this. We'll see why that's the case. Okay, financial position analysis. Short-term assets dwarf their short-term liabilities as well as their long-term liabilities. Now, that's obviously a really good sign. Their debt-to-equity ratio, 16%. Throw in cash and equivalents, and they've actually more cash than total debt. These are all great things. Operating cash flow, though, is negative. Therefore, the debt's not well covered. That is something to take note. Interest payments are well covered, though, by earnings before interest and tax. We make up of their balance sheet. Down to dividend. Okay, it scores 2 out of 6 in this, so I'd imagine it's high. So it's among the top 25% of dividend payers. The dividend, it's higher than the bottom 25, and it's in the top 25. I thought that. 7.5%. It's a good yield, but will it maintain? This chart is one of the most important charts for dividends. Having a wee look through their history. Now, the turquoise line is actually their dividend per share, and their yield is the blue chart. We can see that they were growing their dividend per share quite nicely up until the pandemic. It was cut for a year, and then they reintroduced it at a similar yield. It is projected, though, if earnings and, of course, revenue, if the forecasts are right, their dividend is projected to grow, and their dividend per share as well over the coming years. Something to definitely bear in mind. But their earnings payout being 141% and the cash flow being negative isn't great for the company. They'll need to sort that out in order to sustain the dividend. Sometimes sustaining dividends is more important than growing them, because you wouldn't want a dividend that gets immediately cut unless you believe you got in at good value. Down to management, average tenure is about 3.1 years. That's not the worst I've seen. Richard Simpson's been in for 4 years, so he's basically served since just before the pandemic hit. An admirable time to start. 2019, no one knew what was going to happen a year later. We can see here, leadership team, 3.1 years. And the board members is surprisingly not very experienced at 1.3 years. Perhaps, though, and that's why it's very important to always look into the profiles of these people. Maybe they've moved about within the company and they're actually more experienced than it shows here. When it comes to recent insider trading, buys across the board here, all at about £1, and many of which are actually board members as well. Let's see here. The makeup of their ownership breakdown, most of which is in fact institutions, followed by VC, venture capital firms, the general public, private companies, and then their employee share scheme at the bottom here. Okay, who's top? Octopus Investments Limited and M&G Investment Management as well. Now, a few of those are quite... we've seen them a few times. Octopus Investments, if you remember, actually own quite a large portion of Octopus Renewables. We can also... I'm trying to see... There's BlackRock. I was about to say BlackRock's got a feature somewhere. We see them everywhere. They're actually down at 1.38%. But it's very rare you would see institutions actually owning such a vast portion of the company. The top 25 shareholders own 71%. That is definitely something to take note. Okay, over to Dividend Max. If you're interested in the dividend of a company, this is one of the best free resources that you can use. Gives you a full breakdown of their dividend, everything you need to know, the status of it, the type, how often it's paid, what it was paid per share, declaration dates, and very importantly, ex-dividend dates. Ex-dividend dates, you need to own the share the day before that in order to be entitled to the next dividend. So 2nd of February, you'd need to own it on the 1st. 9th of June, you'd need to own it on the 8th, and vice versa. You can put in as many shares as you were thinking of maybe buying in the company. So say 1,000 shares, and it'll give you the next payment and the previous payment. Down to their annual chart here, you can see just a forecast of every dividend. Usually goes quite far back on many companies. And the annual dividends you can see as well. Chart is very useful. Yields also useful to use. News articles can come in quite handy sometimes. I like to use all of the available resources to look into any company to make sure we're making as informed a decision as possible. Okay, over to Alpha Spread here. It is another way of looking at the company. So this is the intrinsic view. Alpha Spread, you can look at 3 companies per week for free. And it's given them an 80% undervaluation. So we got 60% on Simply Wall Street with the discounted cash flow model. Intrinsic value, which is actually worked out combining the DCF model and the relative value model. These are two, models for checking the value of a company, adding them together, averaging them out, and we get £4.90. Whoa. Remember, it's trading at 99 pence. So if this model was correct into the future, that means they're extremely undervalued. But again, This is base case. Best case £7, worst case £3.88. So they are definitely favoured when it comes to this model. Don't take these models as absolutes. It may never see these share prices. It's just something to bear in mind, especially going into what intrinsic value is and learning everything there is about these models to make as informed a decision as possible. Also in Alpha Spread, you can get financials. It gives you a different way of looking at their balance sheet that is not the same as simply Wall Street, maybe more visually appealing. It's each to everyone's own preference in that regard. But yeah, let me know what you think of Watkin Jones. Is it part of your portfolio? Is it something that you'll be continuing to maybe cost average into? Or maybe you held it when it was £2.60, and are you going to continue doing so? I'll be really interested to hear in the comments. Also, if you're looking a trading platform, I use and recommend Trading 212. It has commission-free investing. Been using them for a few years now, and I must say I'm very, very happy. As long as you stay away from the CFD side of things, the invest side and the ISA is commission-free on trading, so that's good to see. There are other fees, of course, but really useful interface, and the pies are extremely useful to use. I'll see you all in the next one. Thank you.